Alphabet and AMD sinking futures right now with 30 minutes to go until the start of trading. I'm Katie Greifeld.
And I'm Tim Stenevec. Matt Miller and Sonali Basak are off. Bloomberg Open Interest starts right now.
Coming up, a tough day ahead for tech. Alphabet and AMD tumble after disappointing earnings. Qualcomm up next. And beyond tech, earnings abound. From Disney's streaming success to Novo Nordisk's Ozempic boom. Plus, not even Barbie can escape the impact of tariffs. We've got the latest on the trade war fallout, all of that and more coming up. But let's take a look at where markets are trading right now. As I said, not too pretty of a picture, but not as bad as we were just a couple hours ago. The S&P 500 down about 0.3%. That big tech pain that we saw after the bell last night manifesting right now in the NASDAQ 100, down about 0.7% pre-market if you round. Then you take a look at the bond market. A curious bid materializing in the long end. You can see the 10-year Treasury yield currently lower by about 5 basis points. We are below 4.5% and then some. Tim Stenevec, what are you looking at?
Well, you said it's a tough day for tech, Katie, and that's exactly where I want to start. Alphabet did report after the bell yesterday. The company reported saw slower growth in its cloud business. Look at shares now down 7.3%. That growth contributed to lower than expected revenue in the fourth quarter. Moving on to AMD, shares down right now by 10%. Fourth quarter revenue did top estimates. The company gave a solid forecast for the quarter, but it was all overshadowed by this disappointing outlook for its data center business. There is concern that it's struggling to compete with NVIDIA. And over to Apple right now, shares down 2% in the pre-market. China's antitrust watchdog examining Apple's App Store fees and practices in what could be another flashpoint in the trade war with the U.S. We also got some earnings this morning. Taking a look at shares of Disney right now, up about 0.6%. The company did top estimates on the top and bottom lines thanks to streaming income and strong box office numbers led by Moana 2, $1.04 billion in the global box office. My family had a little bit to do with that. Uber shares down right now by about 5.5% in the pre-market. Steady bookings growth, but ultimately missed expectations in the previous quarter. Check this out. The company's CFO also cited the impact from the recent Los Angeles fires and extreme weather in January. Finally, over to Europe, where Novo Nordisk expects sales to surge again this year as it builds supply for its blockbusters, Ozempic and Wegovy. Shares right now up 4%, Katie.
Yeah, well, let's go back to the U.S. and let's go back to big tech, because do you remember roughly a week and a half ago, we learned what DeepSeek was? Of course, it came out with that news that it created an AI model for just a fraction of the cost of U.S. models. Then we all thought this posed existential questions, Tim, over the state of big tech spending. If you don't remember that, it's fine, because apparently no one else does either. Alphabet out with some big CapEx numbers.
This is what's so surprising to me. I mean, I remember a year ago when these companies were punished for increasing CapEx, there was concern that that would hit the company in a way that wasn't positive. Now, essentially, it's if you build it, they will come. The idea being that these companies invest and then they get customers. But what shocked me was that Facebook announcement about 3 days before the DeepSeek news.
It's Meta now.
Thank you. Meta platforms. Because Mark Zuckerberg and company, they knew about that. They still increased their CapEx, and they kept it there.
They did keep it there. One of our favorite functions on this show, Tim, I know it's your first time joining us, and thank you. SPLC, you take a look at the supply chains of these different companies. In Alphabet in particular, Broadcom and NVIDIA are Alphabet's two biggest suppliers, and it makes sense that they're a little bit higher right now, even as Alphabet kind of falls out of bed. Let's talk about the state of big tech and this earnings season now with Mona Mahajan. She is Edward Jones' head of investment strategy, joining us at the desk. Great to see you in person, Mona.
Yeah, great to be here, guys.
So let's talk about the Magnificent Seven. We've had 5 of 7 reports so far, and the consensus was that you saw earnings growth really peak in late 2023, and it's just been decelerating since. It feels like we've gotten more to get worried about in the past couple weeks than we have to get excited when it comes to big tech.
Yeah, you know, I think that's a fair assessment. Look, not only are they getting more competition from Chinese players, global players, we're also seeing the impacts of the trade war really impact those companies with global revenues in an outsized way. So tech falls into that basket very nicely. And of course, there's the ongoing valuation concern. So mega cap tech, when you think about a Fed that is cutting or even pausing rates, that typically helps valuation. But what we see going forward is those companies that have probably better valuation, more scope for valuation expansion, they will be supported more so than this large cap tech cohort of companies that already is overvalued to some extent and facing these challenges from abroad as well.
What would you say is the biggest threat to these companies this year? Would it be the trade war? Would it be rates not going as low as some investors thought they would go in this cycle? What is it?
Yeah, I think the valuation story comes front and center. And look, taking a step back, these are companies that are very well capitalized. They actually have huge cash balances, so they do well when rates are elevated even because they can capitalize on that. They are well regulated. They are more transparent than their global peers. So a lot of good things going on. And of course, AI, we still think is in the early innings of what is a secular bull market. But all that being said, we want to make sure this year that we are balanced. So it has to be a combination of tech, your mega cap tech, but we also want to make sure we have exposure to cyclical and value parts of the market. Those will do well when we do see the benefits of AI spread to the sectors that can gain from productivity, whether it's healthcare, financial services, industrials and manufacturing, all potential beneficiaries of the AI story. So diversification, we think, key theme for 2025.
Well, when we talk about healthcare, when we talk about financials, how specific are you getting? Are you happy to invest at a sector level here, or are you going through each individual earnings calls and doing sort of a bottoms-up approach?
Yeah, generally it's a combination of both, so top-down and bottoms-up approach. And our team, we do the more top-down approach, and we'd say broadly what we're looking at is we want to make sure that we have a basket of companies that one will do well in an economy that continues to grow really above expectations. And what are the sectors that are levered to that? Well, certainly when you think about a sector like financials, for example, not only domestically oriented, valuations are more reasonable, but when the economy is doing well, they tend to do well. And especially this year when we think about deregulation, when we think about some of the pro-growth policies, those companies can benefit from the animal spirits of capital markets opening up potentially as well. So we think about the fundamental factors, we overlay that with the valuation story, and then we do try to do a bottoms-up analysis on top of that as well. So,
Mona, you said we're in the early innings when it comes to AI. At what point do we start to see the benefits of AI go beyond the tech stocks? I'm thinking, when is it easier for, Procter & Gamble to sell more toilet paper and toothpaste as a result of innovations they're making when it comes to AI? And is that the innovation, or is it on the bottom line when it comes to fewer employees at the company?
Yeah, all great questions. I think we're all watching and waiting to see some of these innovation and productivity gains really take hold. One thing I'll say broadly is in the US thus far, productivity has been elevated over the last several quarters. And, not necessarily driven by AI, but perhaps driven by a workforce that has shrunk a bit post-COVID and still cranking out the same type of GDP and economic growth rate. So we're already in an environment where the US has been a winner basically in productivity. We see that continuing to accelerate in the years ahead. To your point, we do think some of the low-hanging fruit from AI is in areas like manufacturing, for example, where you get the robotics element to it. Same thing with healthcare, whether it's the robotics surgery or the EMR systems that the doctors and medical professionals are using. Financial services, a field that we're all very familiar with, also kind of poised to gain in terms of not only research and developing research, but how do we think about asset allocation broadly? So we do see a lot of examples and anecdotally coming to the forefront. We think the next 12 to 24 months we'll see a lot of that come to fruition as well.
Katie, she didn't say anchor replacement,
no,
which is good.
Yeah, I mean, I kind of had my fingers crossed, but I am wondering where we are in the investment cycle of AI, though, whether what we're talking about, sort of the users of AI, the companies that are going to be disrupted by AI, is that an investable theme yet, or is this still more a picks and shovels sort of market?
Thus far, we have seen a lot of the picks and shovels. They have benefited in the stock market so far. You think about the NVIDIAs of the world. They are really developing those capabilities for us. The next phase, we think, the data centers and energy usage. We need to make sure that we have that infrastructure in place before we can massively deploy an AI story. But then we start thinking about some of the disruptions that may occur across industries as well, whether it's labor disruption, to your point, or whether it's, companies that are more technologically advanced really gaining the momentum versus some peers that have not kept up. So certainly we're starting to see that. Picks and shovels probably still, but let's see the next 12 to 24 months.
I think for a lot of people, it's hard to believe it's only Wednesday, given that we spent a good portion of the weekend talking and thinking about tariffs.
Yep.
The view from Washington, D.C. and the uncertainty around this administration, is that weighing on CEOs? Is that weighing on earnings?
Yeah, certainly I think it's weighing on the broader market, the investment professional community, and probably CEOs who are especially importing goods and services and are thinking about what their spend might look like with tariffs, without tariffs, scenario playing it out. And I do think, broadly speaking, we know the old adage, markets don't like uncertainty. And there is a little bit of uncertainty here, whether or not the tariffs are going to come to fruition. We've already seen the Chinese tariffs in place. What I'd say broadly, though, is it's probably a bit of a relief on Monday when the 25% tariffs on two of our biggest trading partners in the globe were walked back a bit. And it kind of led the markets to believe that perhaps this was indeed a negotiating tool or tactic. And we did see some results of it, enhanced border security, et cetera. And so we do think that that provided a little bit, we saw the relief rally in the markets, perhaps even amongst the investment and CEO community, a little bit of relief as well.
Yeah, we'll see what happens over the next month as we get closer to that end of the month deadline and perhaps reimposition of tariffs. A big thank you to Mona Mahajan of Edward Jones. Let's get now a look at some stocks that are moving ahead of the opening bell with Bloomberg's Bailey Lipschultz, who joins us here. Bailey, I know you got your eye on Match. We got a little bit of news in the C-suite.
We've got a new CEO, former co-founder of Zillow, now stepping up to the plate, going to lead the parent company of Tinder and Hinge. Also, though, they did report lackluster results, so the stock under a bit of pressure this morning, really probably driven by the uncertainty around what the path forward is, really in terms of monetizing those two key platforms. It does seem like you're dealing with still a U.S. consumer who's maybe not wanting to spend up for some of these apps or having multiple of these apps. I'm not in the dating game. I know you aren't as well. But also this company dealing with some activist pushback from Elliott Onson. So really kind of trying to thread the needle. One thing to keep in mind, though, stock was up about 18% from a January 10th low. So giving back a chunk of those gains, but could have just been maybe the rally getting ahead of itself.
Yeah, and just let's meditate on that move a little bit. An interesting move to go from Zillow to Match. Not a pipeline that I was expecting. Let's talk about Barbie, though, as well. Maybe some potential trouble in the making in Barbie land, maybe some price hikes. What's going on?
Yeah, it seems like Mattel beating expectations, stocks up 12%, but talking about how they're going to really be more than happy to pass along the costs associated with the tit-for-tat tariffs and what that could mean for consumers. Looking at what management was talking about, though, they're going to try to talk to some of their retailers, see what goods they can raise the prices on. But when you look at the results, this was a pretty strong quarter, and really that being driven by the likes of Uno or Hot Wheels, so cheaper goods really showing up. And that's been one of the things analysts have been trying to see is, if you're a U.S. consumer, as a parent, are you pulling back on spending maybe with Barbie that's more expensive and getting a few Hot Wheels and calling that a day?
So a trade down kind of in toys?
Kind of a rotation trade down.
Rotation
I don't know.
trade.
Are you rotating your spending?
We don't really do a lot of Barbies or Mattel in the house yet.
They're playing with like wooden blocks out in Brooklyn.
Yeah, we're a little old school.
Yeah,
artisanal blocks. Bailey, before we let you go, speaking of China, there's some confusion around a few different headlines that we got late yesterday, early this morning about the United States Postal Service and what's going on with Hong Kong and China. Yeah,
we saw an update this morning that the U.S. Postal Service is resuming accepting those parcels from China and Hong Kong. So we did see weakness in the likes of Temu owner PDD. We also saw a sell down for the likes of JD.com and Alibaba. Losses paired quite a bit on this uncertainty, but kind of the back and forth showing this kind of tit for tat trade war, shipping wars, what that actually could mean for some of these companies, just given the kind of push that we've seen from the White House and maybe cutting back some of those loopholes and also trying to get U.S. consumers to buy domestically as opposed to some of those discount websites.
All right, Bailey, definitely a fluid situation there. Great roundup, as always. That is Bloomberg's Bailey Lipschultz. Now coming up, Disney earnings coming in hot thanks to a good box office, also price hikes to its streaming services. More on the company's outlook next. This is Bloomberg.
Now to high interest, a look at what's making headlines around the world. Speaking at the White House alongside Israeli Prime Minister Benjamin Netanyahu, President Trump said the U.S. should take control of the Gaza Strip and transform it into a, quote, Riviera. Trump's proposal was met with sharp opposition from Palestinian and Arab officials. And the U.S. Postal Service said it's accepting, quote, all international inbound mail and packages from China and Hong Kong posts. Chinese e-commerce stocks are reacting to the announcement, which comes as a reversal. Hours earlier, the agency announced a halt on some shipments. In a statement, the service said it's closely working together with Customs and Border Protection to implement an efficient collection mechanism for the new China tariffs to ensure the least disruption to delivered packages. And Disney shares are rising in the pre-market after first quarter results came in strong, thanks to hits like Moana 2 and Mufasa. A strong performance in its streaming operation and film studio led to a 31% gain in operating income this quarter.
I can't believe that anyone saw Mufasa. I know that Moana was a big one, though. So let's dig deeper into these results now, as well as Alphabet and AMD earnings. We'll do that with Bloomberg Technology co-host Caroline Hyde joining us at the desk. Let's start with streaming, because it seems like these price hikes really helped boost some of these numbers. And Disney still has that ability, it looks like.
Yeah, Bob Iger is actually talking on a conference call with investors right now, saying the churn that they saw in subscriptions was nowhere near as high as they thought it would be. When you jack up prices 25% across Hulu and across Disney Plus, you think more would go for the exit. Not so, and Hugh Johnson, the CFO, joined Surveillance a little bit earlier, saying they really think this will actually return to growth. This is going to be a significant portion of the growth story, of the pillars that Disney provides. They also did so well in their movies, as they said. Moana 2 drawing people out, good spending there from a loss of last year. We're back into profitability. And I think really, even experiences, despite the terrible weather, the fact that people were having issues getting on to some of those boats, getting in to some of the overall parks, they still managed to be flat on the year and signal that actually they're very pleased with the way experiences bookings are off to a great start, they say.
I think the big question a lot of investors have is about Bob Iger.
Yes.
And what happens when his contract is up next December. I mean,
No
do we
news.
know anything?
We know that James Gorman
know what
is
happened
very
last time.
focused on it. We know that the chairman, of course, he was the CEO of Morgan Stanley, became the chairman at the beginning of this year, and that is his number one job. They've promised that they will announce something by the beginning of next year, but no hints as yet. And still Bob Iger taking the helm and managing to really drive and deliver at this moment. There are still issues to be dealt with. We know that TV, the news, the spending they have to do on sports as well, all of that still needs to come into line. So old school cable is still a draw down on them. We know that they'd hypothesized about selling that unit, but ultimately they're trying to make it break even a little bit more.
Absolutely. And they've got until the end of that contract to find another Bob. When exactly does that end?
December 26th.
December 26th, so we'll see.
Clocks are ticking.
Clocks are ticking. I do want to get to Alphabet, though, because I think that what you're seeing in the benchmark level right now, a lot of that is being just reflecting what's going on in Alphabet. A lot of disappointment when it comes to cloud growth here.
Yeah, 30% ain't good enough. And it's kind of synonymous to what we saw with Microsoft, where actually they beat in their fourth quarter, well, the fiscal quarter that they reported on, but the fact that Azure wasn't growing as high as expected. For Microsoft, it was an issue of supply, and they didn't have enough data centers. Alphabet, what surprised Bloomberg Intelligence, for example, was that they make their own chips. They have TPUs. Why are they not firing on all cylinders when it comes to cloud growth? $12 billion, it's a significant uptick, and they're managing to gain market share as we start to see us all needing compute, but it wasn't accessing the growth as quickly as possible. Maybe that's why we're okay-ish with a $75 billion capital expenditure to build out those data centers. But really, this is a company that's trying to tell you that vertical AI is the way forward. We give you the cloud, we give you the compute, we build our own chips, we're giving you the large language models. You're going to be using it better in search, and you'll be using it better when it comes to YouTube too.
Is that a compelling enough value proposition for companies that are looking for cloud providers? After all, Alphabet is the third largest after Amazon and Microsoft.
I think everyone's desperate for compute. Look how OpenAI had to go to Oracle because they couldn't get enough from their main provider, Microsoft. So I think the fact that you can get it from anywhere is important. Google is doing, Alphabet doing great jobs at luring over some of the startups in particular. So this is who's been accessing their compute thus far. But I think this is also a story of just trying to reassure investors, you will get return on our AI investment. It has helped with YouTube, but so did the political spending. What happens in the next quarter for them? I think ultimately we need to start seeing that we're going to be using AI overviews that much more, and we're going to be having a much more sophisticated product. Thus far, search is doing very resiliently compared to the new competitors.
I will say the AI overview,
It's gotten better.
I'm pretty impressed with it.
It's not telling you to eat glue now?
No, no glue, no rocks at this point. But I'm using that way more than I'm using a product like Gemini, for example.
Yeah, there you go.
Yeah.
Using that more than Bing, too, I assume.
More than Bing, yeah.
All right, Caroline, great stuff. Of course, a lot coming up on Bloomberg Technology today. That is Caroline Hyde. Did you see Mufasa?
I didn't see Mufasa.
Did you see
Moana?
Moana?
My wife and son saw Moana 2.
Oh.
Yeah. I was a little concerned. Moana 1 is a little scary.
Really?
Yeah. But
Yeah.
Moana 2, I think things were okay in the theater.
Yeah, I have a cat, so this is not my sandbox.
Maybe the cat would like Mufasa.
That's true. I don't think he would find that scary. In any case, coming up next hour, we'll talk tech investing with Brian Reuter. He is co-CEO of Permira. The Open is coming up next. This is Bloomberg. Welcome back to Open Interest. A quick check on futures right now. Still lower heading into the opening bell, but not as low as maybe we were earlier in the pre-market session. The S&P 500 down about 0.2%. You take a look at the NASDAQ 100. Still a lot of pain when you take a look at Alphabet. When you take a look at AMD, you can see that at the benchmark level with the NASDAQ 100 down about 0.6%. And the Russell 2000, actually the small caps catching a bid here. I do want to briefly look at the bond market, which feels strange at 9:25 a.m. But let's take a look there. We were talking about this bid that we've seen in the long end earlier. You're taking a look at the 2-year here, maybe a little bit of a move after ADP. But if you take a look at the 10-year Treasury, we did get news that Scott Bessent, newly installed Treasury Secretary Scott Bessent, plans to maintain its guidance on keeping sales of longer-term debt unchanged well into 2025. As such, you haven't seen that bid into the long end interrupted by maybe some issuance fears. A lot of haven bids going on right now as we take a look at these tech earnings, which haven't really impressed so far.
Yeah, I think it's fair to say that, we're getting some differing views on how the year looks. Alphabet shares sinking, AMD sinking. We still got Amazon to hear from tomorrow,
yes.
So we'll wait on that. We also got not tech, but Ford after the bell today. We're going to be hearing from Jim Farley on the close as well.
Yeah, looking forward to that conversation. And don't forget NVIDIA in a couple weeks' time.
Oh, yeah, already looking forward to that one.
Who knows what the world will look like then. But coming up, it's the opening bell. Stick with us. We'll take you through the market action. This is Bloomberg. All right, we are moments away from the start of trading on this Wednesday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. We actually saw that relief rally that wasn't here 24 hours ago materialize by 4 p.m. yesterday, really lifting all of the benchmarks, fading a little bit today. You think about what we learned after the bell when it comes to Alphabet, when it comes to AMD. A lot of disappointment there, a lot of disappointment working its way through the big benchmark level, of course, as trading officially begins on this hump day. You have people ringing the bell over at the NASDAQ, over at the New York Stock Exchange, Compass ringing the bell at the New York Stock Exchange. And you take a look at where we settle up on these indexes as trading officially kicks off. A little bit lower when it comes to the S&P 500, a little bit more when you take a look at the NASDAQ 100, down about 0.5% right now. As we mentioned, big tech under a microscope right now. We'll see if Amazon tomorrow can change the sentiment around. What's going on in the small caps is something to keep an eye on. You have the Russell 2000, your outperformer yesterday, your outperformer so far today with the Russell 2000 up about 0.4%. We know that bid is coming through into the bond market right now. That is giving some relief to these small caps, but a lot could change when we finally get to Friday's jobs report. But before we get there, let's look under the hood right now and talk about Disney reporting strong streaming growth after raising prices by as much as 25%. Earnings also got a boost, as discussed, from Moana 2 box office sales, maybe a little bit from Mufasa, but let's move on. Let's talk about Uber right now. Earnings disappointing despite solid bookings growth. The company diversifying revenue with new subscriptions, ride options, and partnerships with brands such as Delta and Home Depot. You can see Uber shares down almost 6% at the moment right now, though. And then finally, one of my favorites to talk about, Novo Nordisk, stockpiling Ozempic and Wegovy in anticipation of another huge year of sales for its diabetes and weight loss drugs. Remember, supply shortages have been a big concern for this company, so you can see shares up about 5% at the moment, Tim.
Yeah, some good news for the company after about a 6-month tumultuous period. Hey, you mentioned big tech under the microscope. That's exactly where I want to go. Alphabet's Google nearly wiping out year-to-date gains after earnings missed estimates. The company does plan to spend $75 billion this year on AI growth, exceeding expectations. Shares down 8.2% right now. Also, AMD says its data center business will see double-digit growth this year, but the outlook's still disappointed investors as it struggles to catch up to NVIDIA. Well, let's take a closer look at these tech earnings with Bloomberg Intelligence senior analyst Mandeep Singh, who joins us here on set. Mandeep, cloud growth, that's exactly where I want to go. What was the issue here for Google in the most recent quarter?
Well, I know everyone is very fixated on cloud growth, but I have to say, clearly they called out the supply constraints when it comes to offering, the GPUs to their customers. So that may have contributed to the deceleration. But the fact that they raised their capex, to 75 billion, and still the cloud decelerated, that was a bigger issue. And one of the plausible explanations of that is, with the DeepSeek moment, I feel the market has moved towards inferencing. So Google, remember, has got 7 apps with over 2 billion monthly active users. Think about this. If they're deploying AI to all their apps, then they need a lot of their capacity themselves. So from that perspective, I can see why they still want to raise the capex, and they could be supply constrained when it comes to the cloud side of things.
So the cloud side, some disappointment when it comes to Alphabet, of course. I also want to talk about AMD, another facet here of the AI trade. Disappointment when it comes to the data center business in particular.
Now, that one is justified simply because if that inferencing explanation holds true for AMD as well, a lot of people believe, yes, AMD didn't really have the right product when it comes to the training side of things compared to NVIDIA, but on the inferencing side, it should be much stronger. And based on the numbers, the fact that they had a slight miss on data center and the guide wasn't anything substantially above consensus, it looks like they aren't really benefiting from inferencing in a big way. And that's where there was some disappointment over there.
Well, speaking of disappointment, there was a little softness when it came to Uber bookings for the most recent quarter. We heard from the company this morning. In fact, we heard an executive blame the LA wildfires and some extreme weather events on some of the softness that we saw. What's your view?
I mean, look, Uber is a global company. They operate in so many cities that if something goes wrong with one city, that's going to impact the numbers. And in this case, the guide was softer. So the overall read-through over there is they aren't really adding a lot of new users, and the ride frequency isn't growing. So can they keep growing over 20% with the threat of autonomous rides, given Waymo is expanding to 10 more cities? And that's where I think there are question marks around that growth sustainability over 20%.
All right, Mandeep, covering it all, covering a lot of downward movers this morning. That is Mandeep Singh of Bloomberg Intelligence. And let's keep this conversation going now, because joining us at the table, we have JPMorgan Private Bank Global Equity Strategist Sitara Sundar. Sitara, it's great to see you in person.
Nice to see you. Thanks for having me.
First things first,
Okay.
I love the blazer. I'm glad that
I
we're
love that
matching.
we're twinning. It's great.
It worked out really well. Second thing, just as important, I want to talk about volatility in this market, because you wouldn't know it by looking at the VIX, which somehow is below 17 right now. But it's been a really rocky past couple of weeks, a really rocky start to 2025 in general. And between tariffs, between what we're seeing in the economy, what we're seeing in earnings, particularly some disappointment at the big tech level, what is your mood music right now?
Look, I think this year, the start to this year has been a tale of two cities. If I can go back to English lit, in high school. And you have some ammunition for the bulls and for the bears right now. On the bullish side, earnings season, despite some volatility that we're seeing in big tech earnings growth has been solid. The entire market is tracking towards 14% earnings growth right now. That is the strongest level that we've seen in multiple years. And the biggest thing for us is that we're seeing broadening outside of just the tech players. Now, tech has led earnings growth over the past couple of years, but now what we're seeing is 7 out of the 11 sectors are showing positive year-over-year earnings growth. 5 out of the 11 sectors are showing double-digit earnings growth, and the leaders on the board right now are financials and comm services. Now, on the opposite side of that equation, we've seen two big, I think, risks bubble back to the surface. One is on the tariff side, which has introduced near-term volatility as people are trying to digest what the magnitude and duration of uncertainty around trade policy is really going to mean for markets, and we saw markets sell off on that. And the other side of the equation is related to tech and the disruption that we're seeing in whether or not the perceived winners of artificial intelligence over the past couple of years, the hyperscalers, the semiconductors, are truly going to be the winners at the end of this. But when we look at that entire mosaic, for us, we are still constructive on U.S. equity markets, and we still see modest upside from here. We would be using volatility to buy the dip.
Well, I want to go back to your point that you made about earnings broadening out, because
Yes.
the stat that I've been thinking about this morning is that you take a look at year-over-year earnings growth for the Magnificent Seven, expected to slow for a fifth consecutive quarter, at least according to Bloomberg Intelligence. And if we do see that broadening out in earnings, is that enough to truly change the leaderboard and the leadership of this market? Because to your point that you would, buy a dip, it feels like any time you see big tech really maybe sell off a little bit, the FOMO just kicks in and people flow right back in.
Leadership, perhaps not, but it brings more people to the table. You need, for a durable rally within equity markets, you need to see breadth over the long run. So when we think about opportunity set now, the areas where we're excited about are twofold. We still think you need to have exposure to mega cap tech. We think that there are still areas and pockets of opportunities there. But a lot of the shift that we were just talking about, from training to inference, on the margin, we're more constructive on software than semi, something that we've been talking about for 3 to 4 months now. Margins have been improving. Cash flow profitability has been improving. We're starting to see earnings inflect higher there too. But we're also talking about opportunities that haven't participated in the market, quality defensives, the parts of the market that are focused on dividend growth, because that, at the end of the day, creates portfolio resilience. And in these times of volatility, we try to focus on timing the market, but when we think about returns over the long run and guiding our clients, it's about time in the market.
I want to home in on one risk that you mentioned, and that's when it comes to AI disruption.
Yes.
And the idea around DeepSeek and what that means for the hyperscalers and for the semiconductor companies. Yesterday on the Alphabet earnings call, we did hear Google CEO Sundar Pichai say that DeepSeek has a tremendous team, and he said that Google's models have also excelled in efficiency. Are companies and investors understanding just how big of a risk this is?
So I think it's a good question. I think there's a couple of ways that we end up looking at it. I think we need to remember that innovation and disruption and evolution with technology is normal. We saw this in the cloud computing cycle also in the early 2010s, where disruption is normal. I think it does add uncertainty as to who the ultimate winners are going to be. It's why we talk a lot to our clients about the need for active management and the need to have someone who is looking at all the details under the hood to figure out who those next winners are going to be. But from our perspective, we see that there's been a little bit of an overreaction on the sentiment related to the magnitude of CapEx. We think the magnitude of CapEx, maybe it'll go down a little bit, but we're still going to see dollars flow into this area. But where that CapEx is going to go will likely shift in the future. So there will likely be new winners to emerge, and we think software is that area. So there are risks to monitor, but AI is here to stay. It's a platform technology of which everything will be built upon it. And if costs do end up coming down on the hardware side, what that leads to is increased adoption, which is what we need to see, which is companies like in financials, healthcare, industrials actually being able to automate their processes better because they're able to incorporate artificial intelligence into their ecosystems faster.
I think a lot of folks still waiting for when that actually happens. I want to end with something. You mentioned volatility moving forward for the year. That's to be expected, given what we've seen so far this year. Using the pullbacks as opportunities to buy, how big of a pullback?
So it's the number one question, isn't it? I think that we wouldn't be surprised if you were to see anywhere from like a 5 to 10% type of correction in the next few months. But I think the biggest thing I'll leave investors with is this. Trying to time the market is a bit of a fool's errand. What we're trying to do is ensure that we're using volatility on a bottoms-up, single stock basis to find the opportunities under the hood to ensure that we're finding these high-quality companies that happen to be where volatility creates a bigger disconnect between fundamentals and market expectations, and that's where we would be leaving in. Less about trying to time the market, but finding those underlying opportunities.
All right, that's a great place to leave it. Always good to see you, Sitara. Appreciate your time. That is Sitara Sundar of JPMorgan Private Bank. Now coming up, a hospitality turndown. Hilton gets downgraded over at Mizuho. We'll have the latest in top calls next. This is Bloomberg. All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Warby Parker getting its first sell rating over at Citi. The firm says that the eyewear company is overvalued after a massive 50% rally in the past 3 months. Shares cooling off a little bit this morning. Next up, Mizuho downgrading Hilton to neutral on valuation concerns. The analyst tells investors that there is limited upside to estimates for the rest of this year and for 2026. And finally, we have Piper Sandler upgrading Simon Property to a buy on the heels of a strong Q4 earnings beat. The analyst cites a strong real estate portfolio and potential for more growth ahead. Shares currently up about 2%. Now, coming up, Barclays releases its annual hedge fund survey. We'll break down the results with Barclays' Kate Holleran next in our Wall Street Beat. This is Bloomberg. Welcome back to Open Interest. Let's take a quick check on stocks. We're about 18 minutes into this session. You can see the S&P 500, it could go green here, currently down just 0.1%. Of course, we were looking at losses of closer to 0.5% pre-market right now. But you take a look at the biggest gainer right now on a points basis. It's Nvidia and it's Broadcom, really benefiting or poised to benefit, traders are thinking, from that capex that you're going to see from the likes of Alphabet. And that's also lifting the NASDAQ 100 a little bit right now. Of course, we were closer to 1% down when it comes to the pre-market session, but currently just off about 0.4%. And then small caps really strong today. We'll see if it lasts, but at least for right now, the Russell 2000 higher by about 0.5%, really enjoying that bond rally that we're seeing in the long end of the Treasury curve. But it's time now for the Wall Street Beat, and hedge funds poised to see limited fresh investments this year, even after delivering a bumper year in 2024. That's the key finding from Barclays' annual Global Hedge Fund Survey. Let's break it down now with Kate Holleran. She is Barclays' co-head of Global Capital Solutions, joining us at the desk. Great to see you in person, Kate.
Thank you. Thank you for having me.
So talk to us about why this is the case, because at least in ETF land where I live, the narrative is that flows follow performance. And you would think after a strong showing that maybe we'd see a little bit more in terms of inflows.
Sure. 2024 was a very strong year for hedge funds. Across the board, all sub-strategies were positive, and investors told us that they in many instances actually outperformed their targets. So it's a great question. And I think there's a couple of different ways of looking at it. The hedge fund industry is mature. Target allocations are amongst large asset owners at their correct state. And liquidity across those larger groups is still tight. So it's not all that surprising. I mean, we are optimistic, as we tend to be. Perhaps we'll see a repeat of what we saw last year, which was starting off very positive, seeing inflows through the first half. Yet the back end did offset some of those with rebalancing amongst better performers. And then, of course, the return of proceeds or gains from some of the larger players.
Help me out with the disparity between the best performers and the underperformers. Because if we look at our write-up at Bloomberg News, we're talking about hedge funds climbing 10.6% on average last year. The industry's second best performance over the last decade, the best showing since 2020. You look at the S&P 500 since 2020, there have been 4 years of double-digit growth that have exceeded 10%.
Right.
So if you're investing money in hedge funds,
yes,
the fees are higher, the performance is worse than just tracking an index. Help me understand the equation here.
So, we go back and we as always make generalizations. However, the purpose of a hedge fund in a portfolio is to produce uncorrelated, strongly risk-adjusted returns, right? So we're looking here for skill above a bench. And most of those outperformance, certainly from some of those strategies, have produced that alpha. It's expensive. That's why you pay higher fees here. And then there's also an evolution in the contributors. So last year, a standout was quant equity. Right, that had an abundance of alpha. We also saw outperformance from the multi-manager segment again after a little bit more of a muted at 23. And similarly, we saw a return amongst the long-short community too, where they had better beating the hedge fund index. But I think for the most part, investors look to hedge funds for that uncorrelated return stream. So something different.
Right, you're trying to diversify. You're not trying necessarily to beat the benchmark. At least I think that's what a lot of underperforming hedge funds say. But I want to talk a little bit about churn, because this is something you talk about in the survey, that there's about $450 billion of assets slated to change hands here between hedge funds, between money managers. And you talked a little bit about performance, but where is money rotating from? And what is it rotating into?
Right. So that $450 billion is what we call our money in motion, right? And it's pretty typical. No big shakeup there. We will always see a rotation to better performers, right? So quant equity being one, equity long short, as I've mentioned. There's also an acknowledgement that we're in a different environment and some strategies that have been somewhat unloved given the opportunity set, namely merger arb, equity capital markets. We will see or expect to see a resurgence given the environment that we're now in. One thing we're particularly excited about, though, aside from the growth of the hedge fund industry per se, is the continued momentum behind these non-traditional hedge fund products. So things like co-investments, equity extension products, private credit led by the hedge fund managers. All of these things are getting support from hedge fund buyers and show the expansion of hedge fund toolkits into other parts of the portfolio.
On the fee side, what are the themes that are emerging in recent years and this year? 2 and 20 still, or are we seeing more creativity when it comes to fees?
So our data would show that it's the consecutive year for an increase in fees. I think there's nuances, of course, that would be headline. We continue to see breaks given for size of ticket, duration. We did take a deeper look into the multi-manager segment. This gets a lot of attention given the pass-through element here. And there was an increase that we observed, again, averages of about 100 basis points of increase pass-through, but that actually netted an incremental 5% of net returns to investors. And this, for managers that have over the last period really honed in on managing their operational costs, so that fixed cost element, which is expensive, that incremental payment for the variable comp of traders was richly rewarded.
Well, Kate, it's a fascinating report. We really appreciate you taking the time to come discuss it with us. That, of course, is Kate Holleran of Barclays. Meanwhile, a quick check on this market right now. You can see maybe that lift, maybe the S&P 500 trying to go green, as I mentioned 7 minutes ago. Reversing a little bit, the S&P 500 down about 0.3%. Big tech also clawing back some of its losses, down about 0.5% at the moment. And I just still go back to supply chains. I do think it's really striking that you do have NVIDIA and Broadcom, the biggest points contributor to the S&P 500 right now. We were talking about the churn of money in the hedge fund industry. And when it comes to big tech, you have all of these big names just spending money on each other.
Yeah, it's a really good point. We actually raised this discussion last week on our show.
Your other show.
The other show.
Right.
The other show. It's the idea that these companies are all spending money on each other. They're each other's biggest customers. You throw in share buybacks to that as well. And there's some concern that there's some solipsism in the industry, at least according to some critics.
Yeah, it works until it doesn't. And of course, the proof will come when we get to NVIDIA later up this month. NVIDIA obviously just has a couple of customers, but boy, do they spend a lot of money. Now, coming up in our next hour, we'll talk to Permira's Brian Reuter on his latest tech trade. And then we'll talk with Liz Hart about the commercial real estate rebound. All of that coming up. This is Bloomberg. All right, we are 30 minutes into this Wednesday trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Tim Stenevec. Matt Miller and Sonali Basak are off.
Let's get a check on these markets right now. We do have more economic data coming out in just a couple of seconds, and you can see the setup right now heading into it is a down arrow when it comes to the S&P 500, when it comes to the NASDAQ 100, and we do have ISM services crossing the wire right now for January. Those numbers coming in at 52.8 for January. That is below the survey of 54, and it's below the prior reading of 54.1. Take a look at prices paid, though. ISM services prices paid coming in at 60.4. Remember, the prior reading was a big surprise coming in at 64.4. We are below that now, but still above 60. So let's get some context right now with Bloomberg's chief international economics and policy correspondent, Michael McKee. What is the picture that we can paint with these numbers?
Well, it's interesting. We've seen a slowdown on the service side. At the same time, we saw an increase in manufacturing earlier this week. The ISM Manufacturing Index came in higher, and all of the subcomponents were higher, including prices paid. Here we get the opposite. Although we're still above 50 for the headline number, we're still above 50 for the production number, 54.5. It's down by 4 points. New orders are still above 50, but also down by about 4 points, 51.3 from 54.4. The employment index is pretty much the only one that's higher, and that's at 52.3 from 51.3. Interesting to see how that gets folded into the forecasts for jobs on Friday. We saw employment rise in the manufacturing area in the ISM number, but today's ADP had manufacturing losing 13,000 jobs.
Where's the weakness here?
Well, it's hard to know exactly which area is the weakest. New export orders go up 52 from 50.1. So it isn't the dollar yet. It isn't Trump trade practices yet. It may be just that we go into January, things move a little bit more slowly. It's not a major change, and we do get some volatility in this on a regular basis.
All right, Mike McKee, stay close, of course. A heavy economic data week. That is Bloomberg's Michael McKee. And let's keep the conversation going now with Brian Reuter. He is co-managing partner and co-CEO of Permira. It's a global investment firm which manages more than $80 billion. The firm's most notable transactions include Ancestry.com, Squarespace, geez Louise, and Golden Goose. Brian, it's good to see you.
It's good to see you, too.
So we're wading through tech earnings right now, big public tech earnings. I know that you invest in the private equity and private debt markets, but is there anything that we can extrapolate from maybe some of the deceleration that we're seeing in big tech earnings into the private, non-public markets that you play in?
Yeah, look, we think I've actually been surprised that big tech has managed to defy the law of large numbers for as long as it has. So some of what we're seeing in the public announcements is really just the comeuppance of some of just the scaling that these businesses have done, which is such big numbers that are out there. We're still very bullish on big tech in the long term. There's so much that's happening with AI, and what that's going to drive is yet another platform wave for these companies, for the public and the private markets, and will be a very rich ecosystem for where we like to play, which is in the application layer above where big tech sits. So we're a long-term investor, we're a growth-forward investor, so we think the kind of short-term volatility, and we think there's a lot of short-term volatility, more than maybe is reflected even in current trading levels. There's still a lot to build on in the public and private markets.
So where are the opportunities specifically in that application layer?
So, I mean, it's across the board. So if you are a digital forward company, and we are a vastly digital investor in growth markets, so we do invest across services, healthcare, and consumer, but more than 2/3 of the portfolio that we invest in is digital. It's consumer internet, it's software, it's kind of related businesses around that. And those are really the areas where there's the nearest term opportunity. Every company that we've invested in, every company that I know, frankly, in software is building and is very excited about what to build right now in really the AI boom, which is, I got to say, in 30 years of doing this job, it's one of the most exciting times to be a digital investor. With that. So in the short term, it's going to be really that application layer on businesses that are building on top of big tech and the major platforms. Longer term, it's actually going to infuse across all sectors. So we think services, the disruption of digital and what AI can do in those traditional industries, healthcare, what it's doing there, are going to be longer term opportunities as well. So across the board, we see big productivity benefits, big digital transformation benefits across really all the sectors that we invest in.
Well, Brian, to that point, I'm really curious to hear what your reaction to the DeepSeek news that we got last week was, because it seems like that raised some existential questions about how expensive the American AI models that are being built actually are. And when you think about the application layer that you'd like to stay in, I mean, are you concerned about expenses here, that maybe the things that are being built could be built much more cheaply?
Yeah, look, we think, we have the view this is a very good thing of what seems to be coming out of China at the moment. So one, the worst case is you've got another platform and another, importantly, open source platform that companies can build on, which is boost more competition. We don't really know, we may never know, how real the training benefits are that have been reported on building DeepSeek as a model. The inference benefits are very real, and they've kind of thrown their hat in the ring for that productivity. That inference benefit is really where you will see the cost advantage for that application layer. And it just ups the game on all of the American vendors and kind of adds one more hat in the ring for that. So we think actually it will still continue to be a very U.S. forward, kind of U.S. led market in terms of the major platforms. But it's good to have a little bit more competition coming from the outside.
It does sound like, though, you're a little skeptical about what we've heard from DeepSeek.
I just don't think we'll know. So, the thing.
Which part specifically?
Well, it's really the training benefit. I mean, if it was, it's hard to see with the disclosures, and you're never going to be able. This isn't a PwC audited number in terms of how much has spent. Very unlike what you see with the big public U.S.
But couldn't another company, given what we know from DeepSeek, replicate what they've been doing using the same hardware?
You could absolutely train a new model
to test their hypothesis.
Yeah, you could. Well, it's very easy to build a model to train on an existing model and kind of borrow the weights from it in a much more efficient way. That doesn't avoid in the long term the actual capex that you need to do to build the models originally. So what's missing in kind of the exploration here is how much of this was really kind of ground up build at a very much more efficient model versus using and leveraging the existing models to kind of train for that. In either case, though, these inference benefits, which is where that cost for application companies is going to be derived from, is going to be a good thing. I'm a subscriber, by the way, to the Jevons paradox side of this, in that the cheaper you make these things, the more it's going to boost demand for it. So it's the old steam engine gets more efficient, results in more usage of coal despite the efficiency gains. In this case, it is the models becoming more efficient. The coal is capital, it's compute power, it's the semiconductors. I think you're going to see continued inflation of demand for all of those things.
Katie, take a drink. You said Jevons paradox.
That's right. I was thinking. I have to imagine that the Google searches for Jevons paradox just
since last Monday.
Yeah, really. We're all experts now. But of course, AI is a big theme. DeepSeek is a big theme over the past 2 weeks. Let's talk a little bit about trade tensions, and let's talk about that multi-front tariff war, if you want to call it that. When it comes to the type of investing that you do, again, playing in the private markets, tech focused, how do you take that in as a factor?
Yeah, I mean, our operative word for 2025 is volatility, and it's trade, it's geopolitics, it's technology. There's an enormous amount that is going to come that's just going to be up and down. What we're talking about in 12 months, looking back on 2025, is going to be different from what we're talking about today. On the trade side, happily for us, we have not an enormous amount of exposure, certainly to the existing kind of north-south discussion of product kind of across borders with Canada and Mexico. As a digital investor, like traditionally the digital industries have been exempt from these kinds of risks. We have a little bit kind of across the ocean with Europe, but not a lot of exposure there. And that's been a conscious choice over the last 5-6 years. The good news is, despite all the news about when there was a risk of a trade war, the market reaction, as much as that was the headlines, was actually pretty muted. The markets are still up, as you guys see, like very much this year, including Q4. And so
we like to make a big deal out of the little moves, though.
The little moves are important, but if there really were a trade war coming, you would have seen, this wouldn't have been a couple 100-point drop in the Dow. You would have seen thousands of points if the market really thought there. So we're believers in general in the wisdom of markets, and we think the market's betting on there's going to be a deal here in the works, and that's likely continuing.
Our team reporting that you're looking to open an office in Dubai, joining private equity peers that have increased their presence in the Middle East in recent months. Last night, we heard some controversial comments from President Trump. Does that make it more difficult to do business in the Middle East?
The Middle East is a very important market for us from the standpoint of investors. So that's where we get actually a significant amount of our capital, and we very much expect that to continue. We have a lot of allies in the region. These are very friendly countries, and there's an enormous amount of capital there to be able to continue to fuel not just the public markets, but the private markets with investors such as ourselves. So we expect that very much to continue, and we will continue investing in
even if the U.S. establishes a presence in the Gaza Strip?
I don't know about that. That's independent of where we see, the capital in the region, where we get capital from in the region.
Right.
So, yeah.
Brian, before we let you go, when we think about, again, the investing that you do, $80 billion in committed capital, you invest in private equity and credit. Where are you seeing the most opportunity right now? Is it on the debt side or is it more on the equity side?
It's across the board. The credit markets, now that there's interest rates back and you can actually get yield on credit, has been a very consistent area for us to invest in. Has been actually kind of better overall return lately than it had been over the prior decade. We're seeing the growth market actually come back. That had been very dormant for a while. So we do control buyouts. We invest in the earlier stage growth. That market's starting to come back and show some better signs of life. But really, especially in the good growing economies like the U.S., we're seeing really nice opportunities to back, disruptive growers. These are multiples of GDP growth companies, either in taking those companies private or investing in, private companies that already exist. So lots of good opportunities on both the private equity and the credit side. 2025 is likely to be a very dynamic year.
Yeah. Brian, good to see you.
Thank you
Thanks
guys
so much for joining us. Brian Reuter of Permira joining us here in New York. Well, let's get a look at some of the stocks that are moving at this hour with Bloomberg's Isabel Lee. Isabel, I want to start with AMD shares down 10%.
Yes, that's the lowest intraday since November 2023, and the company gave a disappointing outlook for its data center business. And this is an area where it really struggles because it can't catch up with NVIDIA. And AMD did say its division will grow strong double digits this year. But again, this is an industry that saw NVIDIA sales double in the past 2 years, and yet analysts still weren't happy. Overall, though, it was a good report. We have AMD reporting fourth quarter revenue, the top estimates, and the forecast was solid. But still, that was enough to spook investors, down 10%.
Yeah, the bar is just super high right now, it feels like. Let's talk about the biggest loser in the S&P 500 right now from a points basis, Alphabet.
Down 8%, largest drop since October 2023. I'm loving all the size and scope here. So 2 reasons.
Done a ton of them.
Yes, 2 reasons. First is the slower growth in its cloud business that contributed to lower than expected revenue. And also, they increased their capex to $75 billion for 2025. That's a 29% increase from what analysts expected, which is $59 billion. So again, it's hard not to see this as almost a dispute to the Chinese upstart DeepSeek that's saying it just cost less than a fraction. They knew this, and then they still went on. And we have Microsoft aiming to spend still around $80 billion. And we have the CEO saying DeepSeek is a, quote, tremendous team, but that their models are also excellent in efficiency.
Okay, let's go from a company worth trillions down to a company worth about $18 billion. Snap. Shares are down. Yesterday after they reported, we saw a spike. What happened?
That spike, I think it's just investor digesting, but now it's down 6% to session lows. And Snap may not be a $1 trillion business, but it is important to the zeitgeist. So Snap reported stronger than expected gains. It gave an upbeat forecast. And this is great news because we know for a while that Snap has been trying to overhaul its ad business. So they moved away from broadly targeting advertising to more targeted. So think of when you see something and then it invites you to buy something or invites you to download something. It's what you call direct response ads. So at least that's working. We have Evercore saying that this is better than feared, but the long-term outlook is still mixed. But who knows? I mean, I don't use Snap, but I think. Do you use Snap?
I try to stay current with the trends with the kids. I'm on TikTok in a big way. I can't get behind Snapchat. It feels
I feel
young.
like you're like the demo of Snap.
Really?
Yeah.
I don't know. Am I in high school?
No, it's
you
high
were
school,
though.
Kim.
It's high school kids.
It's high school.
Yeah.
It's been high school. So what happens to those high schoolers when they get older?
You
Where do they
graduate
go?
and you go to
You go to
TikTok.
TikTok.
You go to Instagram.
Well, you go to
and
TikTok while you still can.
Yeah, that's true. Isabel Lee, great roundup as always. And coming up, we'll turn to politics because President Trump proposing a U.S. takeover of Gaza. We'll have more on that proposal next. This is Bloomberg.
Now to high interest, to look at what's making headlines around the world. Honda and Nissan are questioning the agreement to consider merging the two companies, casting doubt on their efforts to form one of the world's largest automakers. A collapse of the discussion would spell trouble for Nissan, which was counting on its Japanese peer for a lifeline. Nissan's standing in the global auto industry has steadily declined thanks to listless leadership and an uncompetitive product lineup. And VC giant Andreessen Horowitz has hired Daniel Penny, the Marine veteran who rose to prominence after he was acquitted in the subway chokehold death of Jordan Neely. He'll be working as a deal partner in a unit that invests in government and defense opportunities. And speaking at the White House alongside Israeli Prime Minister Benjamin Netanyahu, President Trump said that the U.S. should take control of the Gaza Strip and transform it into, quote, a Riviera. Trump's proposal was met with sharp opposition from Palestinian and Arab officials. For more on this story, we're joined by Bloomberg's Michael Shepard, who joins us in Washington. Michael, some of the reporting that I read about this late last night indicated that very few people within the president's inner circle actually knew that he was going to say something such as this. How's it reverberating around Washington, D.C.?
Well, it's being met with a lot of skepticism and a lot of perplexed views from Democrats and even some Republicans, how this would come together. It raises many more questions than it could possibly answer at this moment. First of all, how would they pay for it? Second of all, what about the voice of all the Palestinians who are living in Gaza right now under dire humanitarian conditions? What is their say in all of this matter? What does it mean for the two-state solution? And I think on that front, it really does not seem to be in Donald Trump's vocabulary right now. He didn't seem interested when asked about that during the news conference with Benjamin Netanyahu, the Israeli prime minister, who was the first foreign leader to pay that White House visit to Washington since Trump's inauguration. And this does fall into the line of some of these other expansionist ideas we have seen Donald Trump float since shortly before taking office and since becoming president. The Panama Canal, taking U.S. control there, Greenland, even Canada, and now Gaza as well.
Yeah, it's a good point. I mean, when you loop it all together like that, certainly seems like expansionist is a term to use here. Talk to us about the timing of this suggestion, though, because you think about that 6-week ceasefire. It started last month. Does this proposal, if you want to call it that, put that in jeopardy potentially?
Well, one other way to look at it is perhaps this is another one of Donald Trump's maximalist bargaining positions. We've seen him do that on trade. He brought Colombia to the brink of heavy tariffs for refusing to accept plane loads of migrants into their country from the U.S., and the threat of tariffs forced the government in Bogota to capitulate in a lot of different ways. And here, with the ceasefire really into its second or third week, and looking ahead to how it will be extended, is Donald Trump trying to put pressure on neighbors to maybe take a few refugees in, well short of the proposal he floated last night with, of course, very few details and naturally incurring a lot of negative reaction across the Middle East, not only from Palestinians, including the group representing them, the Palestine Liberation Organization, and the group known as Hamas that controls Gaza and that has been declared a terror group by the U.S. and the European Union, but also U.S. allies like Saudi Arabia, which have looked very skeptically on this whole idea and expressed their interest in seeing the two-state solution that the U.S. previously has backed followed through on.
Hey, Michael, I want to go to a different part of the world with you right now, and that's China, and specifically what we're seeing when it comes to a potential probe of Apple. Our Bloomberg News team reporting exclusively that China's antitrust watchdog is laying the groundwork for a potential probe into Apple's policies and the fees it charges app developers. Shares of Apple down 1.8%. What do we need to know?
Well, this is an important data point to watch here, Tim, because Apple has so much business in China. It's the second most important market after the U.S. for the company. And it has had some struggles there recently. In the most recent results issued last week, we saw an 11% drop in revenue over the holiday quarter when it should have been performing better. And also, Apple really depends on China heavily for production of the iPhone and other devices. So the threat of an antitrust inquiry is significant. Now, it also echoes moves made by the European Union for similar complaints about the App Store's structure and rules in the bloc. And actually, Apple has made, under the Digital Markets Act in Europe, some changes there that perhaps it may need to follow through on in China. The difference is, of course, the context, with Donald Trump having already imposed 10% tariffs across the board on Chinese goods and weighing whether to go further later this year as they review that Phase 1 trade agreement that they reached at the end of Donald Trump's first term. Apple is really caught caught in the middle. What is an antitrust probe could be something much more and tied to all these trade tensions between the world's two largest economies.
Yeah, absolutely. Great point there. Apple getting caught up in these trade tensions between the two biggest economies. Great reporting. That is Bloomberg's Mike Shepard joining us from Washington. Now, still ahead, life in plastic, not so fantastic these days. Barbie price hikes may be coming your way. Details next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Chipotle reporting disappointing sales. The burrito giant has been one of the few chains that's managed to actually bring in more customers over the past year, but meeting investor expectations has become more challenging. Next up, Hogs had a rough 2024. Motorcycle maker Harley-Davidson reporting a worse than anticipated fourth quarter loss. And the CEO blames cyclical headwinds and diminishing consumer confidence for that mix. Finally, brace yourselves for higher prices on popular toys such as Barbie and Hot Wheels. Mattel's CEO says the company is willing raising prices to offset the cost of Trump's tariffs. Remember that Trump introduced a 10% tariff on goods made in China, where Mattel sources about 40% of its products. Shares currently higher right now by the tune of 16%. Of course, a good earnings report will do that. Let's take a look at the broader market right now, though, because you can see the S&P 500. If we flip up this board, it's been red for most of the morning, and it still is. Same too if you take a look at big tech. Coming up, commercial real estate. Great discussion with Liz Hart. Don't go anywhere. This is Bloomberg.
If you look in Park Avenue in New York, we've seen vacancy decline from 15% to 7%. And I think we're going to start to see rents moving up and values, I would say, for pretty good quality office buildings around the country have fallen 50, in some cases as much as 70%. So we do see some opportunity.
And that was Blackstone COO John Gray speaking to Bloomberg last week. He says that the worst is over for the global office market. And joining us now is Liz Hart. She is Newmark's president of leasing for North America. And Liz, it seems like John Gray is in good company because I think you agree with him.
I 100% agree with him. I think it's been 5 years since the pandemic. The worst is behind us. And the indicators that we look at to see an improving market are all there. Capital markets transactions are up. Lending is up. Distressed asset sales are up, which means there's opportunities, there's capital formation, there's people who are really wanting to buy these buildings, reposition them, and get them ready for the next generation of tenants.
What's the nuance geographically here? Because we know the story in New York. We've been in New York physically for the past few years since the pandemic. It was a different story during the pandemic and post-pandemic in a place like San Francisco. But then enter, the AI boom starting 2 years ago. What happens in San Francisco?
I mean, San Francisco is looking pretty good right now. So the demand is up. It's at pre-pandemic levels. And what's really interesting is not only in San Francisco, but across the country, we're seeing the emergence of big block leasing again. Leasing that's over 100,000 square feet. And that can really move an asset's value because it's a big deal. Financial services is one of the most active groups across the entire country, but technology improved 150% year over year in terms of large block leasing. And we'd expect that to continue again in the next 2 years.
That's interesting. I mean, when you break it down at the industry level there, technology, financial services, we talked about San Francisco as well, maybe returning to its pre-pandemic normal. Is there anywhere where it still doesn't feel like we're seeing that resurgence when you take a look at your different geographies and those different markets?
No, I think across Trophy in every single market, we're seeing the resurgence. And I think that's really been the story of the last 2 years. The chapter we're entering now is the next chapter. So we know that Park Avenue is tight, using that as an example again. We've heard about that. We've seen the big Citadel transactions. But, what about areas like Hudson Square as an example, where you have Google anchoring it, you have Disney, you have Anthropic and Notion moving in. I mean, those are neighborhoods that really have the right fundamentals to see a lot of growth. And it's not just in New York, it's in areas like Soma and San Francisco as well. Menlo Park, where you really see the combination of good credit tenants and then emerging technology tenants, but also all the service providers that want to be working with those sectors. So you do see an emergence of law firms, financial services, professional services that are trying to get closer to those growing areas.
So we know there's demand for Trophy. You said that. What about Class B and Class C? What happens to those buildings? Do they get bought and converted into condos, as we've seen a couple prominent examples here in New York City? Or do they get remodeled and turned into Class A office buildings?
I think there definitely will be a substantial portion, like maybe 2% of the entire office inventory that will turn to resi. And we'll see that.
So very small number.
Very small in total, but a big compared to what it's been historically. And I think we will see that. But what's really interesting about what you just said is we all know the Trophy story is good, especially for post-2019 construction. But the Class B rents have really been holding their own. So you haven't seen those declining. So I'm feeling pretty good about Class B across the country as well. Class C, I think we're going to have to do something about. That's going to be a little bit trickier.
Well, what do you think needs to happen? What are the necessary ingredients to see that interest come back when it comes to those maybe lower quality properties? Is it lower interest rates, maybe risk appetites coming back as a result? What do we actually need to see in terms of catalysts?
I think it's just overall economic growth, which we're seeing, right? So overall demand growth in those markets, and then also just repositioning of those assets. So going back to what we said about distressed sales, in that category, the 20% or so of assets that have too much vacancy for being refinanced at the current moment, they're going to have a new buyer come in, put money into that asset, and reposition it, and that's going to be where you're going to see that value change again. And there might be some buildings that just need to go.
Has the catalyst been returning to the office?
Certainly in part.
You said economic growth is certainly part of it, but you can have economic growth, and if people don't need offices, then they're not going to go and get offices. Is it because there's been this narrative shift in the big cities that's like, okay, it is time to get back to the office?
I think that the narrative shift has been very definite over the last quarter, and I'd expect it to continue across all segments. We aren't seeing anyone right now who's really moving to a more hybrid environment. It's all moving towards a more in-office environment, and it's stabilizing it over 3 days a week, which means that you do need to have a full-time office for every person who's coming in.
Yeah, it does feel like the tide has certainly turned there. You did make a point that some of these buildings just need to go. When you think about some of the lower quality buildings out there, I mean, how much is that in terms of the supply? How much of that is just, kind of, it's not going to be renovated?
Yeah, I would say, low single digits.
Okay.
I don't think it's very substantial. I think that a majority of the office real estate across the country is in a pretty good position right now to be reinvented with the new demand that we're seeing coming in.
Liz Hart, good to see you. Thanks so much for joining us.
Thank you for having me.
Here at our office.
Yes, at our office in person.
Liz Hart of Newmark. Well, coming up, Pfizer has a cancer in its crosshairs. Wall Street Week's David Weston sits down with CEO Albert Bourla to talk about the vaccine maker's ambitious new target. This is Bloomberg.
Time now for our daily Wall Street Week conversation. And Pfizer announced earnings this week, beating expectations on surprisingly strong sales of its COVID-19 vaccine. David Weston spoke to the company's CEO, Dr. Albert Bourla, about Pfizer's next mission, combating cancer.
We can detect cancers way more efficiently today than we could do it years back.
Dr. Albert Bourla is the chairman and CEO of Pfizer. Under his leadership, the pharmaceutical company partnered with BioNTech during the COVID-19 pandemic to roll out life-saving mRNA vaccines.
How to operate with speed. The vaccine, or the operational warp speed that President Trump actually had initiated, was an operation that removed obstacles, but also within the companies was an operation that we were shooting for the impossible. And we came with a mindset, nothing is impossible. We can make it possible. That's a mindset that we can use again, not to find a solution for COVID, but to find a solution for cancer or for Alzheimer's.
Cancer is Dr. Bourla's next big challenge at Pfizer. In 2023, Pfizer completed its $43 billion acquisition of Seagen, a company basing a particular cancer treatment on monoclonal antibodies.
You have made cancer a real priority for Pfizer in your investments, in your R&D, in your development, even your acquisitions. Why?
Because we think that we are ready to provide a solution. We want to save the world again. And I think our best chance this time, it is with cancer. The science is there. We invest probably double than all the profits that we made with COVID to acquire a new technology, which is promising a lot.
The number of U.S. cancer cases may be going up, but the mortality rate is actually going down. It's fallen 34% in the last 30 years. And the National Institutes of Health project that if this trend continues, the United States will have 26 million cancer survivors by 2040, a 44% increase over 2022. Pfizer hopes to keep this trend going through one particular oncology treatment turbocharged by its acquisition of Seagen.
It's called antibody-drug conjugate, or ADC technology. And this is like a missile, but it is GPS guided. so it doesn't go anywhere in the body. It's going straight to the target, which is the cancer cell. And what is on top of this missile? A warhead, which we call payload, a chemotherapy that is going to be targeting those cells.
And that was Pfizer CEO Dr. Albert Bourla, and I'm pleased to say that David Weston joins us now. So when you think about Pfizer and their portfolio, they really need another blockbuster because they're coming off of 3 straight years of losses.
Yeah, and of course, Pfizer's stock has suffered as a result. Initially, it went way up with all the profits off of COVID, and then it came down. And there's some activists in there as well that he's very conscious of, Albert Bourla. At the same time, he, from the beginning, has said we need to take on cancer as our next goal and to find a solution to that. And that's why they bought Seagen, and that's the bet he's making. And he believes that they can make some enormous progress here with new technology.
David, we can't talk about this without talking about the political environment around vaccine makers. We saw shares fall yesterday after Robert F. Kennedy Jr. moved past a Senate panel closer to confirmation. What does a company like Pfizer do in this new administration?
Well, when I talked to Bourla, he had just come actually from Washington, where he was on the dais for the inauguration, and he talked to the president, and he'd been to a dinner that included Robert F. Kennedy Jr. And the way he puts it is they had a very good discussion. They did not talk about vaccines. They just decided not to talk about that. But on balance, he thinks that the opportunities from the Trump administration actually outweigh the risks.
Like regulatory opportunities?
Yeah, and the opportunity, because he thinks the president is really, really committed on cancer. Really wants to do a version, perhaps even of Warp Speed, and apply that. That was a success, obviously, the last time around, to apply that to at least some forms of cancer. Obviously, there are lots of forms of cancer.
Yeah, it's interesting. I mean, I was at the JPMorgan healthcare conference in San Francisco last month, and I agree that the environment, there was just a ton of optimism over the Trump administration, especially when it comes to M&A. Of course, Pfizer has done some pretty huge acquisitions in the past, including of Seagen, so I don't know if they're looking to spend money there. But you think about, I don't know, the conversation around vaccines, and it seems like cancer, as you're alluding to, would be politically friendly as well.
Yeah, no, it would be a big thing, and it would actually make a name, not that he needs it for Donald Trump as president, if he actually could have a solution. Again, I'm not even necessarily saying cure. If you heard, Bourla was careful to say it's a solution, because maybe some things you can really cure, some things you have to have actually as an ongoing problem, but people can deal with for the rest of their lives.
What did you learn about a timeline for a potential solution such as this from Pfizer?
He thinks we are, I'm not going to say close, but we're talking about a matter of years, a few years, rather than decades. He thinks that we're getting very close. Now, he has a particular technology. There are others as well, but it's monoclonal antibodies that sort of finds the cancer cell. But his version attaches that to a toxic chemical that then really directs it. And what it allows you to do is, instead of using chemotherapy for the whole body where you come close to killing a person, you can direct it, and so you can use much more toxicity because it's against a very narrow target. And so you can really make progress.
It's just fascinating. Obviously, that would be a huge boon, not just for Pfizer, but for people in general. So definitely going to keep an eye on that story. That is David Weston. And you can catch Wall Street Week every Friday at 6 p.m. Eastern. But still ahead on this program, Janus Henderson launching its first fundamental stock-picking equity ETF. We'll speak to the company's head of America's equities, Marc Pinto, up next. This is Bloomberg.
You hate to say it's a stock picker's market, but it really is now. Last year, and even in 23 especially, it wasn't so much a stock picker market. It was just buy hard, large cap, quality growth. That was it. That's all you had to do. Now I think there's opportunity to do stuff more at the stock level.
And that was Morgan Stanley Chief U.S. Equity Strategist Mike Wilson speaking with us just yesterday, talking about how really this time he means it. It is a stock picker's market, and Janus Henderson agrees with him. They're leaning in to that stock picking approach because today they're launching their new actively managed equity ETF. It has a portfolio of about 20 to 30 stocks. The name there is the Transformational Growth Equities ETF. And I'm pleased to say that joining us now is Marc Pinto. He is Janus Henderson's head of America's equities. Marc, it's great to have you with us. Just talk us through the approach here, because you have other equity ETFs in your lineup, but this is the first really bottoms-up, fundamental sort of strategy.
Yeah, that's exactly right. And it's great to be here, by the way. So if you look at our legacy as investors, we are high conviction, growth-oriented investors, and we've always relied on our deep fundamental research to identify long-term trends and opportunities that in companies that we think will transform the business environment and the world. And so this strategy is exactly that. It focuses on a number of key themes. It really reflects the best growth ideas coming from our analyst team. And it's a great complement to portfolios or investors who own a lot of index-oriented strategies, because this is not index-oriented. It is not a Mag 7 portfolio. It owns one Mag 7 stock, which is Amazon, but it offers insights and opportunities into a lot of other segments and areas that include AI, but also include a lot of other themes. So we think this is a great way to get exposure outside of the Mag 7.
Yeah, well, it definitely caught my eye, since you're seeing this growing trend in the ETF industry in particular of these highly concentrated, high active share portfolios coming to the market. As you see, of course, the big tech Mag 7 names really just get bigger and bigger, it feels like. But talk to us about the makeup of these 20 to 30 sort of best ideas that you're putting in this portfolio. Do they tend to fall into one specific sector? What is the common denominator here?
So it's really a wide variety of themes, and they cut across a lot of different industries and a lot of different geographies. So obviously AI is an important theme, but we choose it to express it in maybe different ways than the index expresses it. Migration to the cloud, deglobalization, the digitization of the economy, and healthcare innovation. And look, the aim is to invest in high quality, competitively advantaged businesses that have this long-term growth potential and might be, names and investments that an average investor might not come on as easily as some of the better known Mag 7 names.
You mentioned that Amazon is the only member of the Mag 7. It's about 4.3% of the portfolio. You also got TSMC, ICE, Oracle, United Health among the other top holdings in the portfolio, Marc. How active is this going to be? Are you doing daily buying and selling of stocks? Do new stocks enter the picture frequently?
So look, that obviously will be at the discretion of the individual portfolio managers, Brian Recht and Nick Schomer. I would say that historically we have a long-term orientation in our strategies. And especially when you think about the types of companies we're investing in, if we're right, these companies will continue to compound in terms of revenues, growth, and earnings. And so we would expect that the turnover might be on the lower side. Again, it really depends on the environment, but no, this will be ideas that we think can stand the test of time. And of course, we'll make changes. We'll increase and decrease positions as we normally do. But this will not be a ultra high turnover strategy.
Okay, so low turnover, high active share, high conviction here. Let's talk about the market that you're launching into, because it's been pretty volatile. We're dealing with a lot of trade tensions. We're dealing with a lot of earnings right now. And it's also coming at a time where you're seeing a lot of disappointments on the earnings stage. I mean, how much thought did you put into when to actually launch this? Did the market environment cross your mind, or did you just want to get this out the door?
No, I think, look, this has been in formation for quite a while. And I mean, I would tell you that the dominance of the top stocks in the index is something that's been very much front and center in our thinking. I mean, to put it in perspective, historically, the top 10 stocks in the S&P 500 have underperformed the other 490. Of course, as we all know, that has changed dramatically in the last couple of years. And it could change at some point in the future. It's hard to predict. But we think there is an opportunity to invest in, the remaining 490 companies in the index and names that maybe are not as well discovered. And I think this is actually a really good environment for it, because if an investor owns, whether it's an S&P index fund or a large cap growth offering like some of ours that do have a lot of exposure to the Mag 7, this is a great complement because it gives you exposure to high quality growth companies, but not the ones that you're going to see at the top of the index.
Are those people you're referring to, Marc, are those money managers? Are they retail investors? Are they both? Who's it for?
No, we're talking, it's really for retail and institutional investors. I think as in the ETF form, which, it's not lost on us, is becoming the preferred vehicle of choice for individual investors and their financial advisors. It is a great complement to an individual's broader portfolio of holdings of different funds, different securities, and different asset classes.
Well, let's continue that thought when it comes to fund wrapper here, different structures, because of course, Janus Henderson, you have a long history of this sort of investing in the mutual fund wrapper. This is your first, again, fundamentals strategy to make its way to the ETF wrapper. Should we expect to see more of these types of funds coming in the ETF format?
Yes, I mean, certainly our legacy is in mutual funds. And we think the mutual fund as a product delivery mechanism is still solves a lot of needs and is very popular. It's where the majority of our business is in. But clearly ETFs have gained prominence. We've all seen the numbers in terms of net inflows into ETFs. And at the end of the day, we want to deliver products that our clients want to invest in a wrapper that they prefer. And so strategies like this in an ETF, we think it makes sense. We're somewhat early in the game in our ETF launch strategy, certainly in equities. As you know, in fixed income, we've made great progress there. But in equities, this is a little bit on the new side, and we think that this is the first of many ETFs that we would like to launch, and we think it's a really good one to start off with because it goes back to the roots of Janus Henderson and high conviction growth investing.
Well, it sounds like we'll be speaking to you again soon then. That is Marc Pinto of Janus Henderson. And tune into ETF IQ every Monday at 12 p.m. Eastern. And good news, you can read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF newsletter. Tim, I assume you're a subscriber.
I'm a subscriber. Have you written this week's yet?
No. That comes out on Friday.
Yeah.
So I will be
Time is
writing
running
it.
out.
I'll be
Clock is
writing
ticking.
it on Friday. We should probably look at markets.
Let's
We have
do it.
25 seconds left. The S&P 500, it's still lower. What's interesting is that you have more names that are higher right now in the green than you do have when it comes to decliners, but still Alphabet really weighing on this index. We'll see how that develops over the course of the trading day, but that does it for Bloomberg Open Interest. I'm Katie Greifeld along with Tim Stenovic. This is Bloomberg.